parties in a real estate development. Real estate investment capital requires the coordination of capital and talent from various parties. Equity partners are the people who put up the money. Lenders put up debt capital. By the way, when I say the word financing, what do most people think of, do you think? Going to a bank. Anything else? Mortgages. Yeah, mortgages. In other words, most people, when I say, how do I finance this, most people's mind go directly to what? Debt. That's what financing means to almost everybody, and that's not so. When I say, how am I going to finance this building, what I mean is, how am I going to bring all of the money that it takes to buy the deal and make and carry it or fix it up or whatever is required in the deal? How am I going to bring 100% of the necessary money to the deal? Some of it may be debt, some of it may be equity. My personal prejudice is most of it, or at least more of it, ought to be debt, but ought to be equity than debt. Most people, you go to seminars and people say, oh, we're going to teach how to do 100% financing deals. And what they mean is 100% debt deals. Really scary to me, because when you're in bed with a lender, when you get all your money from the lender and you close on the deal, how long do you have how long do you wait before paying your first dividend?
30 days.
Start again. 30 days. 30 days from now, typically, the lender wants his first payment. Okay, now let's suppose that everybody in this room gives me $10,000 to go buy something. How many days do I have to make my first payment? Whatever the documents say. I may say that if there, now this is the cool part, it will say, if there is any money to be distributed at the end of the first quarter, I promise to distribute it. Right? Tell the bank that. You go tell the bank, okay, I understand your loan document, but I need to insert a clause. If I have enough money at the end of the month, I will make your payment, okay?
That's what's happening now.
Huh? Exactly. Well, that is happening now. That's not the way they planned it. That is not the way they planned it. But that's what they do. Okay? So now, people, I was in Las Vegas, or Henderson, Nevada, which is not exactly Las Vegas. March. Where did I go? March. And I'm talking to 2,500 people in a big room, allegedly, mostly real estate investors, right? And we're talking about this debt and equity thing. And let's see, I started to say this story. I had an excellent reason for telling you this story. What did I just say?
Everybody can pay their debt. Yeah, mortgages. Banks repaying the dividends. That's what you want to.
Okay, this is a good review. I can do this for a living, right? Oh my gosh.
How do you chauffeur?
Yes, but this is such an easy proposition. I'm going to have my chauffeurs, two stunts, tell you what I meant. Right? Oh God. I was in Henderson, Nevada. Why did I say that story? Good Lord. Aren't we just talking about debt and equity, financing?
And the clause about I'll pay you in a quarter.
Yeah, I'm sorry. That's right. And somebody in the audience, I'd go through this whole explanation, right? And somebody in the audience says, well, see, the problem is, he says, that sounds good. He says, but you bring in a lot of investors, you lose control. He says, you bring in a lot of investors, you're only going to get like 5% of the deal for yourself. And I said, yeah, okay. But if I bring in a bank for 75% of the deal, and I put up 25% of the money, who's taking the biggest risk? He says, well, the bank is. I says, are you kidding? The bank will not lose all of their money. Isn't that right? They might lose some money, but if this deal goes south, how much will they lose?
Some after you're 100%.
Anything after whatever you invest in.
Yeah. See, they have only, let's suppose they've lent 75% of the value of this property. Well, if the value of the property goes down 25%, by the time they sell it, now it could go down worse than that. But what are the chances they are going to lose 100% of their money? Zero. Just about zero. If it burns down, they sell the land, right?
Yeah.
Okay. How much money am I going to lose as a percentage if the deal goes south? I lose it all. It's like they talk about the difference between commitment and involvement. At breakfast, the chicken was involved. The pig was committed. Okay, when you're dealing with, and that's what happens when you're dealing with the bank. And by the way, I don't get a bigger share of the profits when I deal with the bank rather than dealing with the equity, right? If most of my money is equity, most of my money has to wait for my dividends. I got lots of safety, right? So I prefer to borrow. To borrow less than 50% of the money that I need for a deal. If I could raise 100% of the money for a deal, that would be my preference. You just can't get any better than that.